Wouldn't it be nice to know where the next hotspot is, where the next big thing is, so that you can invest in those locations, buy the property that increases in value, and then you can repeat it and do it again or sell up? The thing is, though, that investing in the next big thing, in my mind, could backfire spectacularly. And that's the discussion we have today as I have a chat with Brett Warren, National Director of Property at Metropole. We explain the difference between speculating and investing, and we break down the strategy that successful investors who build large property portfolios that give them financial freedom, we break down the strategies that they use. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of all the mixed messages regarding the property market so that they can develop the financial freedom they're looking for, as we teach you about strategic property investment and smart money management. So let's break down the myths of hotspotting.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Brett. Good to have you back on our weekly chats here on the Michael Yardney podcast.
Always good to be back, Michael, and plenty to talk about, as usual.
Yes, there is. Look, Brett, after all the years I've been involved in property, I'm still surprised how some investors decide which properties to buy. I guess it doesn't surprise me then why so many don't get past their first or second property. I think a lot of people are buying for emotional reasons, and especially at the moment, I think some feel they've missed out the big growth in some of the capital cities. Others think they're investing when in many cases, actually, Brett, well, in my mind anyway, they're speculating.
Yeah, I think so. And I guess another word for that is guesstimating too, isn't it? Because they've probably got some hunches or some ideas, or they've heard something from someone that kind of aligns with what they're thinking. But I guess if we look at the definition of speculation, it's the practice of engaging in risky financial transactions in an attempt to make a profit in the short or medium term from market fluctuations, rather than actually attempting to profit from the underlying financial attributes embodied in what you're actually investing in. So I obviously hear people all the time talk about investing and look at an area hasn't had capital growth for a while, and obviously it's about to take off and it's primed to take off. And I think at the moment the opposite could apply also, Michael, because I know there's been plenty of locations that have probably done nothing for the last 10 or 15 years, and all of a sudden the last 5 years they've done exceptionally well. And I think that's going to run out also. And we're also getting people, I guess, putting reports together and using data and science and all that kind of information. They often lack a little bit of perspective to find out where that next hotspot is. And it's very much a short-term focus, isn't it?
It's short-term, and in fact, in many ways, you've got to get your timing right. So you not only have to get the location right and the asset right, but also the timing. Look, obviously people want to know where the next hotspot is. They want to jump in and take advantage because people are in a bit of a hurry, especially with what you tend to see on social media, where people say how many properties they've bought or how much capital growth they've had. But if you ask my opinion about hotspots, I think over the years they end up getting disappointed in their results. I know the media at the beginning of this year asked me, where are the best 5 growth suburbs? And the journalist was disappointed when I wasn't prepared to tell them. In fact, I told them honestly, I don't even know. And by the way, I don't really care either.
Exactly.
So maybe
they obviously don't know you too well, Michael. If they're asking you for a hotspot, they probably haven't read your background. But I guess, like you said, if we do take a bit of a step back and actually work out what hotspotting is in real estate, just clarify that to start with. So perhaps you can give us some insight there.
Well, in my mind, hotspotting is speculating, and I'm not in the business of speculating. Instead, I make my decisions based on proven long-term performance rather than short-term speculation. Hotspotting, I guess, is looking for the next boom location. That's not really true property investing. Now, there's no doubt that people who bought at the right time in Perth or in Adelaide, and definitely in Brisbane, but more likely in regional Queensland rather than the big capital city of Brisbane, they've done very, very well. Their returns have been very, very good in the short term. So there's no doubt that if you get the timing right, it almost creates a self-fulfilling prophecy when there's a whole lot of new people out there pushing some of these hotspots. But in my mind, investing is different. It requires the intention of generating long-term capital growth that tracks above the average as long-term price growth for an area. I know at the moment, and we've spoken about it in previous podcasts, that some of those who put people into Perth are now saying, hey, it's time to sell up. And I just recently read some statistics that a lot of investors are selling up in Perth. I don't know where they're going to put their money. They're looking for the next hotspot, I guess.
Yeah, look, it's a common thing at the moment. And look, who can argue in the last 3 or 4 years? Like you said, everywhere's kind of done well. But for me, one of the things you originally taught me when I first started investing, Michael, is be very careful if you get it right the first time, because ordinarily it's probably more down to luck. So I guess these people are looking for the hotspot in areas where the real estate prices are going to jump quite rapidly in a short period of time. As you said, there's speculation, there's piling on. People, the reporters and the people are all kind of trending into the same location. There's some media buzz. And I guess there's that promise of that immediate return, and everybody wants to be right. And some of it has actually happened in the last couple of years. But I don't think there's been the evidence and the information to back it up. It's been a bit of an anomaly, I guess. And that's quite often what we see with hotspots, especially in the last couple of years when interest rates have been high, and obviously many investors have been chasing those secondary areas, those regional locations. And as we can probably start to see, I'd suggest in the next couple of years, the shine's probably going to wear off pretty quickly, right?
It will. Now, again, let's be blunt, the hotspot at the moment for a lot of people is Melbourne. But there's no one Melbourne property market. There are 5 million people living in the capital of Melbourne, and there are high-rise apartments, established homes, townhouses, units, homes in the outer suburbs, homes in the inner suburbs. And it looks like the hotspot now is going to be the outer, cheaper suburbs of Melbourne. So to say Melbourne is going to grow, and I think we both agree that it's primed to do that, you can't just go anywhere. So the hotspots, I guess the areas I'd be avoiding, we've seen it before though. We've been around long enough to see that some properties bought in regional locations are going to lose value and often be hard to sell. I mean, there was the big extreme of the mining boom. I think the next mining downturn, so to speak, the similar thing is going to be in far north and regional Queensland, where, yes, property values went up a bit, but with the unfortunate challenges of climate change, a lot of those properties are going to be uninsurable in the future. So there's no doubt that the Townsvilles and the Mackays and the Cairns have done okay. But what happens when people aren't going to buy your property in 5-10 years because they can't get insurance, Brett?
Well, it's almost like a race to the bottom, isn't it? So I guess if you are investing in those short-term trends, everyone wants to be right at the end of the day. And I guess it's being right is the thing that counts. But very few can do that. No one can pick what happens next. And history becomes very, very important.
You've got to be right at the right time, not just right.
You do. And, we've put together some information as well. I mean, there's a data lag as well. So, most of the portals are getting their information through after a sale 3 or 6 months later. Yep. So there's always that kind of data lag. I mean, that kind of information's got a lot more efficient over the last few decades, but there's still a bit of a data lag, and very few people can pick that and get the history right. So I know you often talk about having, I guess, expectations and thinking over the longer term and looking for areas with a proven track record of capital growth over decades, not just a couple of years. They're likely to perform, and then we start breaking it down into the location, the demographics, the supply and demand, the type of people that live in that area. So look, I guess on that, maybe we can start talking about some of the downsides of property investment hotspots. And I guess the first thing is really, it's about that short-term speculation, isn't it?
Sure. So there's no doubt that hotspotting is sexy. There's no doubt that getting quick gains is appealing. And so some people would say, these guys are old-fashioned, they're fuddy-duddy. We've just been around the block a few times and seen the end result. So I agree with you that it's actually speculating. And when people do that, I'll often ask them, are you an investor or are you a speculator? And they don't even think about it that way. So in my mind, the key is to build a substantial property portfolio and use your first property to leverage off the next one, and then use those two properties to leverage further. So we're buying properties to buy more properties. And if you get it right, you get reasonable capital growth and reasonable rental return, you can basically leapfrog. But you're only going to do that if you buy in the sort of locations that will consistently pass on capital growth, Brett, not just short term, because this year's hotspot is very likely to be next year's not spot.
Well, that's right. And going back to that definition I spoke about before, the hotspots are not these types of areas. They're just as quickly to heat up and cool down in these locations once they kind of come off the boil. And as you said before, the mining towns and the sea change locations and things like that have kind of come off second best. The other danger, I guess, Michael, it's also almost following the crowd. You're waiting for the crowd to move before you move. So, I guess that's another point as well, following that crowd.
Well, at the moment, the old days, there used to be get-rich-quick seminars. Now there are get-rich webinars and masterclasses, or you're getting a report online, or there's a whole lot of younger, inexperienced buyers agents. And I'm not saying they're being wrong or malicious. They don't understand. They haven't been around long enough to see that these short-term predictions are often self-fulfilling. Now, Perth is a big capital city, and there's owner-occupiers who've driven that up. But if you look at some of the regional locations around Australia, particularly in far north, in Queensland, where there are smaller local populations, and all of a sudden you get 2 or 3 companies who put their investors there. By the way, they don't even go there. They don't fly in and fly out. They get the local selling agent to do a WhatsApp or a FaceTime video and show the property. But if there's only a small number of properties and more people looking for it, you actually create that self-fulfilling prophecy that values go up, it pushes up prices, because all of a sudden there isn't that much depth, there aren't that many properties there. Hey, and you prove that the hotspot's right, Brett.
Well, that's right. But what happens next? That's the big question. And that's what people, I guess, don't really understand. Look, unfortunately, a lot of these areas lack that long-term, productivity, economic growth, and they focus on that short-term and getting it right. And even if they get it right, they've still got to get in and out of those markets. And I've often heard you spoke about, property being a very expensive game to get in. You're paying stamp duty and all those kinds of things, and agents' fees and capital gains to get out. So it's kind of, one step forward, but also one step back. And I guess on the other hand, Michael, people looking for, a wealth creation, strategic investors, they don't really get swept up in the hotspot. You just mentioned before that you really don't care what the next hotspot is. They have more of an analytical approach, I guess.
It is. So property investing is part art and part science, as we often say. The science bit is doing the research, but then you've got to put the perspective on it as well. But the research we look at are economic fundamentals. You look for areas with a diverse economy so that you don't have the up and down fluctuations when droughts happen, or when a particular industry gets tariffs put on it, or when other challenges happen. So we look for areas where there's multiple expanding job markets and diversity, where there's substantial infrastructure investing, and we don't really see that in the regional areas, and where there's population growth. But Brett, it's not just population growth, population with people who've got higher wages, who are able to and prepared to pay more to live in those areas. And you're wanting areas that it's the owner-occupiers who make the market. They're the ones that are going to underpin it when the market turns in, and all markets eventually do, and investors aren't as active there. So we look for economic fundamentals, because that will drive population growth, because wages are going to go up, and people often move to locations because they want to rent, or they have to rent first till they find out where they want to live, how they want to live, and then they will eventually buy. I also like areas with large, expensive infrastructure developments, reliable public transport, schools, healthcare facilities. And that's one of the reasons why I believe the Brisbane property cycle is going to go on longer. The growth phase of property cycles in general lasts 3 or 4 years. And that's why I believe that Perth and Adelaide are now coming to the top of this particular cycle, but they can then be extended by government interference, and that sometimes is grants or tax incentives. But in Brisbane, I think the government interference is going to be a positive interference in regard to substantial infrastructure spending. So at the moment, the media is talking about the hotspots in Brisbane where property values are going to double because of the Olympics. I'd be a little bit cautious about that, because it's not only those areas that are going to grow up, Brett, because I think we're going to get the ripple effect as well. Do you really want to be right next to the new stadium, or would you rather be a suburb away, which is still going to get all the spin-off effects?
It's a really good point. I think Wollongabba's tipped to be one of those suburbs, Michael, but you've got Wollongabba. There's a huge amount of work going on there. There's hundreds and hundreds of thousands more apartments to come out of the ground. You're too close. You're on top of things. It's not a great area to live, and it's an investor hotspot, I guess. But why not focus a couple of suburbs out that is quieter? There's more infrastructure. Maybe there's a really good school catchment there, and you're on the doorstep of these kinds of things. I guess the other thing, Michael, you've mentioned there, which I think is really important. I mean, people are getting into the science and the data and all the information. But one thing I think we're starting to see now, and if you haven't got this in your toolbox as an investor, you should start listening to a bit of a plug for your other podcast here, Michael, your demographics with Simon Kirstenmacher. That the demographics is amazing, and I think understanding the different segments of the markets, and and what's going to drive those particular segments. We're talking about, I guess, the baby boomers downsizing. They're not doing the sea change and tree change. They're probably tending to stay put and get into something, right sizing. And then also those millennials who, I guess, lived in those inner city areas and partied for a bit longer than we all probably did at that age. And now they're kind of moving into that family formation stage. So if you can break that down to another level and get into those kinds of locations, you're going to do exceptionally well.
I guess the underlying thing, Brett, is all the things we just spoke about are long-term. Gentrification of a suburb is 20, 25 years. If people move in because they're baby boomers downsizing or millennials moving into family formation stage, that's not a short-term speculation thing. It's a long-term thing. If they're going to build infrastructure, whether it's train lines, getting rid of railway crossings in Melbourne, building amenities, schools, that's long-term. Yeah. That's the big difference, isn't it?
100%, 100%. Michael, how long have you been doing this for?
Well, I genuinely don't remember if it was 71 or 72 that I bought my first investment, because my records don't go back that far, but it's been over 50 years, over 5 decades.
So how many property cycles? 10, 15?
Well, yes, more than 10, I would say, because some of them were short, some of them were long. That's right.
I guess I'm asking that question, Michael, because the thing about hotspotting is it requires timing. And when I first started listening to you, and I listen to you now, I've never, ever heard you say, I can time the market, I know what's going to happen next. But there seems to be all these people.
I've been the beneficial recipient of good timing, but to be honest, it's not because I was so smart.
Exactly.
I just happened to be there.
Well, look, most investors don't have that necessary knowledge to know when the right time is and the right time isn't. And there's certain hotspots that probably generate that, and you can maybe time it a little bit. But when I hear someone like yourself with a huge amount of experience saying, I can't time the market, we see major economists, we see banks, we get all those kinds of people get it wrong. It really rings alarm bells. And that's the downside of hotspotting. You do have to get the timing right. And quite often the timing is in areas where, I guess, homeowners have come in, they've driven the market, they've pushed the market, and then investors kind of pile on top, don't they? And I know there's a lot of people still investing in Perth at the moment. I think they're probably going to be quite late to the party. So getting that, I guess, timing can be very, very difficult.
Well, that's right, because by the time the media picks it up, somebody's already moved the market to the next level. So if you're there for the long term, that's fine. But you want an area that is, as we've said a few times already today, going to outperform in the long term. So I guess hotspotters get it wrong in two ways. Either get in too early and wait for a long time, or you have your money tied up and miss out real opportunities elsewhere, or get in too late, which happens every cycle because people have read, people see that others have made killings. So I want to do it as well, and they miss out about that. I think it also relates a lot to people's opinions rather than facts. Now, we're human. We do have feelings. We want our state, our city, our suburb to do well. A lot of them comments on social media and podcasts are, this is the next big thing. It's got to take off. It hasn't done well for a long time. It's got to take off. Now, while we say that we believe Melbourne is going to do well, it's not because we would like it to. It's because of the underlying fundamentals that are there that we believe it's more likely to make it happen.
I also think, speaking of opinions, I also think salespeople are very, very good at finding out your hot buttons or your push points. Yes. So right at the moment, if you're looking to buy somewhere, it might be a hot spot. So someone's wanting to make a quick win. But the other thing they're talking about is cash flow positive, and you won't have to lay a cent, and it's going to cover the mortgage. So they're rather than appealing and giving you facts and data and taking an evidence-based approach for a long-term wealth creation strategy, they're trying to solve a problem immediate to lure you in to get into, I guess, break down the barriers around, your holding costs and what you've got to do to get into it, and make it as easy as possible. So I think that is something to watch out for as well.
Definitely. And we're talking at the moment about the downside of hotspots as opposed to long-term investing. And I'd like to maybe have a bit of a talk with you about the alternatives, what we could do right. But I guess I've already suggested it, that hotspotting can create overheated markets where there's just prices go up beyond what the fundamentals would suggest. An example in the last years was where people living on the east coast of Australia bought into Perth, where relatively prices were very cheap. So they thought they're buying cheaply, but they were paying considerably more than what the locals would be prepared to pay. Much the same happened in Far North Queensland, where hundreds of investors there jumped on the bandwagon and brought some of these regional towns into the spotlight. That happened very much so during the resources boom, and when the resources boom cooled off, property values went down a bit. and they had a difficulty offloading their problems. I think much the same this time around with inexperienced investors and some active buyers agents putting too many clients in the same hotspots in regional locations. Yes, it's pushing up values, but is it really pushing up the fundamentals? What is going to make those properties keep going up in value when the investors decide not to continue on?
So, Michael, if we think beyond the buzz, we've outlined a couple of those points for the downside of hotspotting and things. What's the long term strategy? What a strategy and approach have you taken over the last 5 decades?
Well, I guess I changed over the years also, because when I started, I was in a hurry to get going. I guess I was protected by the fact that there wasn't social media and there wasn't the internet. So it took a while for all the research to come through. So you had to take a more long-term approach then. But what I've been looking for are areas that always work rather than areas that are working right now. So the long-term approach, as we've said a couple of times, is looking for the underlying fundamentals, starting with, well, actually, I think it starts even before you look at property with a plan. And that's why when people come to Metropole, when prospective clients come and they ask, where should I buy? What should I buy? How much should I pay? They get a bit surprised that we don't start talking with property, Brett. We talk about putting a plan and a strategy together.
Yeah, definitely. I know a lot of people jump straight in and talk about a property. They've just so happened there's one out of 100 properties in this particular complex that are perfect for each of those people. But yeah, it comes back to understanding your long-term plan, like we spoke about, taking a long-term approach. If you're speaking, you've got a couple of properties in Melbourne and you're speaking to someone in Melbourne, they're only going to be able to recommend Melbourne. So having a balanced approach, an independent approach is really, really important. And as you often say, it's the manifestation of all that data, the facts, the information, but it's also having a level of perspective and understanding how to do that is really, really critical. So that's exactly what we help people do to, I guess, navigate those risks, invest safely, and, think longer term and back it up with that longer term thinking.
Well, what you asked me was what you do instead of hotspotting. So the first step is to have a plan. And the plan is what you should do, how you should structure your ownerships, because you've got to think of the future, because most people are investing, and they should be thinking long term, are going to keep their properties for 20, 30, 40 years while they're still alive, and for many clients even longer than that. And most of them actually want to leave a legacy for their family and children. So should they own them in their own name if that's the case? So get good advice on which ownership structures to use, and then own the sort of property that's going to be in continuous strong demand over the long term, not just by owner-occupiers who are going to buy it, similar properties, and push up the value, but also by tenants. And so therefore you want your tenants to be the sort that have got higher incomes, that are prepared to pay a premium rent in those areas. Now, Brett, you know that yesterday one of our clients came down from Sydney to have a look at the property developments, the townhouse developments Metropole runs for our clients. We help them become what we call armchair investors, armchair developers, where we find the right site, pull down the old house in due course and replace it with 2 townhouses that the client keeps in the long term. And I actually happened to be there with Greg Hankinson, who runs our projects division, and our client who came from Sydney. And we actually went through a couple of different developments that we're currently building, but also passed a whole lot of developments that we've recently done. And it was fascinating. It was during the day, but in every third one, there was actually a Mercedes in the driveway.
Right.
And I thought, I was pointing out to our client, whose name I won't mention, that we're investing in gentrifying affluent areas where tenants don't necessarily rent because they're poor. They rent because they want to be in the right school zone. Some of them are rent vesting. Others are renting because of the stage of their life. They just got married. They just got divorced. They're downsizing or whatever. And it actually just showed and also you can tell their affluence because of the levels of rent they're paying. But I guess it was just a sign that there are no issue with having Toyota Hiluxes. In the old days, it used to be the Commodore Ute in the yard. Right. So that showed the demographics that we look at when we choose and select areas in which to invest. So you start with the big strategy, and then you do a top-down approach and see which is the right location in the right state, in the right capital city, and then the property, and then finally the price, because it's the location that's going to do most of the heavy lifting. But it also depends where you are in your journey, Brett, because if you're a beginner, you're wanting more more capital growth to buy the next property, as you get into your journey, then it stops being as much an accumulation strategy as a slowly lowering your loan to value ratios to get to the time when your properties are going to start paying you back. So all those factors have to be taken into account, and then you choose the right property to fill that need.
But geez, I'd prefer to be getting all that right rather than worry about timing and who's buying here and who's buying there. And, you mentioned following the crowd before. I know the crowd I'd prefer to follow. It's not investors who get emotional and think short term and do all that. It's all the owner-occupiers who, they're there for 7 or 10 years. If there's a downturn or a recession, they'll eat magic noodles to get through that period. And those markets are very, very safe. They're not volatile. They're emotional markets where people will overpay, as you said. They've got higher incomes. They can do those kinds of things. So I'd prefer to invest with a level of safety, knowing that that's going to happen, rather than speculating and get into these other areas that may or may not work out.
Well, Brett, the problem is, who do you listen to for advice? Because there are people out there who are so-called advisors who really are representing developers or project marketers. The estate agent isn't going to give you the right advice. So when we catch up next week, I'd actually like to have a chat with you about the things the media doesn't tell you about property investing,
How long have we
because
got?
that's a good one, because in fact, most people are now getting their advice from the media, and in fact, in particular, social media. So let's put our thinking caps on, and I think that'll be a good chat next week, Brett.
Sounds good, Mike. Michael, always good to chat about these kinds of things, and I think that'll help our listeners as well.
Great. Catch up with you next week. Thanks, Brett.
Thank you. Bye.
As always, I enjoy my chats with Brett Warren. I think we covered some great topics. I hope you got some benefit from them. And as we talk about property, maybe you're wondering, where are property markets headed this year? Because the market just seems to be changing. Well, I agree with that. In fact, the market's going to be very different this year from last year. We're already moving into the next phase of the property cycle. So I guess my question to you is, did you take advantage of the opportunities the previous phase of the cycle offered us over the last couple of years, where some markets had double-digit growth? And are you ready for what's ahead? In my mind, the next few years are going to be very different in property than they were in the past. You may have to change the strategy you're using if you want to buy what I call investment grade properties. At this stage of the cycle, I think investors should seek opportunities in undervalued markets with got long-term potential capital growth, rather than chasing the frenzied hotspots such as Perth, Adelaide and regional Queensland, which are very likely going to be reaching their peak. So let me help you. Why not turn to the multi-award winning team at Metropole for independent, unbiased property and wealth advice? You're going to find that we're much, much more than just another buyer's agent. We help our clients safely grow into generational wealth through real estate by offering strategic property and wealth advice. And we're big enough to tip the scales in your favour, but small enough to care. So whether you're just getting started or you're wanting to grow your portfolio, our team can help you with time-tested strategies, frameworks I've fine-tuned over 5 decades, and we've been helping our clients with for over 26 years. And we've got true on-the-ground experience, but we have no properties to sell, but we've got offices in Australia's biggest capital cities. Having the team at Metropole on your side could mean the difference between outperforming the average investor, and of course, that could give you and your family the financial independence you're looking for. So why not have a complimentary, obligation-free wealth discovery chat? Just go to metropole.com.au. I'll leave a link in the show notes.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to discuss 2 big mistakes that people tend to make. One is worrying about what other people think about you, and the other is believing other people think about you in the first place. And this sort of relates to something I'd like to discuss with you today, something called the spotlight effect, something that is dangerous, but it's something you can fight back. Okay, the spotlight effect is a common psychological phenomenon where we overestimate the degree to which other people are noticing or observing our actions, our behaviours, our appearance, our results. It's grounded in, I guess, an egocentric bias, the tendency to see everything through our lens and believe that our perspective is the only perspective. I guess the phrase the spotlight effect was coined by a group of psychologists in around 2000. following a research study where they asked students to wear an embarrassing shirt and then estimate how many of their classmates noticed the ugly outfit. And the students thought 50% would have noticed it, but in reality only about 25% did. In a similar study, students were asked to rate whether their classmates looked better or worse than average throughout the semester of classes, and the results showed that the students had significantly less awareness of the appearance variations in others than they perceived in themselves, actually. Okay, I think there are two takeaways from this. We think everyone's staring at us and noticing us, but they're not. And even if they are, they very quickly forget about it. So the spotlight affect's why we feel there's a spotlight shining on us in public and in our social situations. And I guess this has a number of negative consequences in our life. Preconditioned fear of placing yourself in the spotlight means you shrink yourself down from your true potential. You don't take on the big opportunities for fear of the spotlight. You make yourself small in public situations by speaking quietly, by avoiding eye contact. Of course, not everyone's like that, but there's a number of other ways it shows as well. Memories of prior spotlight failures create anxiety in some people. It means that the anxiety isn't forgotten. It often lasts for weeks, months, or even years, as some people seem to feel. They remember things that happened years ago and therefore shrink away from taking opportunities now. Self-consciousness that spotlight effect causes manifests itself as self-centeredness in certain scenarios. Your own concerns that others are staring at you or noticing at you may lead to asking others about your appearance, which comes across negatively despite not being your intention. And the other ways it's avoiding doing things that increase your happiness. Maybe dancing at parties on your own or just going for dinner on your own in fear that other people may judge you. Look at them. I guess we may never turn off this completely, but there are some benefits from turning down the spotlight. So while we feel it's more pronounced for some people than others, the spotlight effect, I guess, affects everybody. No matter how socially comfortable or confident we tend to be, it does creep up into most of our lives. So here's 3 simple strategies to fight it back. First of all, awareness. The first step to managing the impact of any of these cognitive biases that we discuss occasionally on this podcast is to be aware of it. Understand others are never as tuned into your actions, your behaviours, your appearance as you are. And even if they do notice you, it's quickly forgotten as they're mostly focused on themselves. Look, I guess we're biologically self-centered creatures, aren't we? The next thing is something I learned many years ago from Jay Abrams, a marketing guru, and he said if you want to get other people to like you, be interested rather than interesting. I think most people go to a public situation with the desire to be interesting, to impress other people with interesting insights or stories. Instead, Jay Abrams taught me, focus on being interested in them. Ask questions, listen intently, be engaged. This eases your own tensions, gets others talking, and builds up your confidence in new social situations. And the third way of overcoming this spotlight effect is the so what approach. Whenever I think about a future or present spotlight situation, I try and confront my worst fears about what could go wrong. In the case of an upcoming public speaking event, I might think about stumbling over my words or forgetting I can't even say it now, some of the prepared things. And then I say, so what? What's the worst thing that could happen? What if I don't remember to say those comments? It doesn't matter. My family at home still loves me. My life moves on. So usually the so what isn't nearly as bad as we think. So these 3 simple strategies go a long way to helping you fight back the negative impacts of the spotlight effect in your life. Give them a shot, and I'd love to know how it goes. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?